Here's what's coming up on Strategic Wealth with Matt Dickett.
Yeah, so variable annuities fees range anywhere from 3 to, I've seen them as high as 8%. They average around 5.
One of the things that we talk to individuals about all the time is that as you get closer into retirement, one of the most important things you can do is make sure that you don't take losses, because what's going to happen is a loss is going to hurt you a lot more than a gain helps you. Okay, I think probably the most common assets that we meet with individuals in the office that they have in their portfolios right now are probably going to be individuals are holding mutual funds. We'll see a lot of annuities, and we'll also see quite often, becoming more and more popular, are going to be ETFs or exchange-traded funds. Obviously, they're called ETFs for short. So, Jordan, you want to talk a little bit about maybe some of the differences between, say, an ETF and a mutual fund? Because they're pretty similar, but they're obviously, when you start drilling down on them a little deeper, pretty significant differences, aren't there?
Yeah, well, I'd say the biggest thing that's different about them is the fee structure. With mutual funds, like we've talked about before, they could be somewhere between 2, maybe 3%, whereas an ETF, they're much more efficient, and that makes a huge difference for portfolio performance.
Now, why is that? Why are they so much cheaper?
Yeah, well, first of all, there's no manager on it, which a lot of times with mutual funds, there's management costs because you're paying someone to manage the funds. And as well as that, index funds or ETFs, they track an index, whereas a mutual fund, they choose the different holdings in the mutual funds, which can be much more
So a lot of buying and selling then, right?
Exactly.
So with the index fund, it's just tracking an index, so there's no turnover. And even though you mentioned that there's no manager, like you have with a mutual fund, that's where obviously the advisor then comes into play, right? To kind of manage it for the client. And you don't have to pay 2 different people to manage it. You're just paying the advisor to manage it. Well, what about annuities? Good, bad? What do you think?
Yes and yes. So it depends on what type of annuity there are. I mean, there's 3 different major types of annuities. Number one is going to be a fixed annuity, and the way it works is very similar to a CD. So what it is you have a contract with an insurance company for a certain number of years for a certain amount of interest. So we like fixed annuities. They work very well. They've been a lot better in the past in interest rate wise. Yeah. But they're still at between 2 and 4% is be a really good fixed annuity right now. The complete opposite of that would be a variable annuity. So what a variable annuity is it's following the market. So it's going up and down, and it's wrapped in an insurance wrapper.
Well, it's basically just mutual funds, right, and an insurance wrapper.
Exactly right. Yeah, yeah. So variable annuities fees range anywhere from 3 to, I've seen them as high as 8%. They average around 5. Yeah. So
and that's per year.
Per year. Whether it makes money, loses money, doesn't matter. You're going to pay that fee every year. And then there's an indexed annuity. So the way indexed annuity works is you kind of take the good from both of them. So you take the upside potential of the variable annuity, but you take the downside protection of the fixed, and you combine them together. So the way it works is when the market grows, you get to grow with it, but when the market starts to fall, you don't lose anything. And the way it works or the reason it's called an indexed annuity is because you pick an index to follow.
So typically S&P 500 index, but there's some others like the Dow, the NASDAQ, even some bond indexes, things like that. So same thing is true though, Jordan, with say mutual funds and ETFs. I mean, you can really diversify and invest in a lot of different things. So how do you make a determination whether an annuity or an ETF or a mutual fund is what's right for the client?
Well, a lot of times, and I know we do this a lot, is use the rule of 100, where it's your age and that's the part of the portfolio that has to be 100% safe. In a scenario like that, an annuity could be appropriate. And then the remaining portion left over, that could be in maybe some mutual funds or some ETFs. But as we talked about, mutual funds have high fees, so in a lot of instances, it's safer to stay away from them.
Yeah, I think as we continue to move forward, I really think that exchange-traded funds, ETFs, are going to become more and more popular, and I think one day they'll surpass mutual funds. We talked about the fees. ETFs are much more cost efficient. They're really better from a tax standpoint. They don't have the inefficiencies. If you're holding the assets outside of an IRA or a 401k or something of that nature, then an ETF is going to be much better, much more tax efficient. And one of the things I really like about them is they're all bought and sold daily, all through the day. And what I mean by that is, obviously we know mutual funds are all bought and sold at 4 p.m. So you can't do anything to really get a price target or set a safety net underneath it like you can with an ETF, because those are all bought and sold throughout the day. So you have all these different investment vehicles. Dustin, why don't you wrap it up by sharing with individuals, how do we know, once again, how much money, we have things like the rule of 100, but how much money should somebody have in an ETF or a mutual fund or an annuity, or are there some cases where individuals shouldn't have any money in those types of assets?
Yeah, it's all going to boil down to what that person's goals are. So really, it's about working with someone that asks the right questions and understands what the client's trying to accomplish, and then you'll build a plan around that. So it could mean that we'll have 40 or 50 or 60% of their portfolio in safe investments like annuities. And then if they're comfortable with risk, then you can take some risk with the balance of it. Then we want to have some in the bank as well. So it's got to be a well-diversified portfolio.
Now, there's even sometimes where maybe if someone wants to take a little more risk with their portfolio, because we work with a lot of our clients' children, sometimes our clients' grandchildren, they can maybe have a larger percentage in things like ETFs or mutual funds and maybe less money in things that are safe. I mean, it really depends. Every client situation is different. If you have questions about some of the assets that we just talked about, or if you're really unsure of what you have in your portfolio, it's not unusual for us to meet with individuals that think that they have ETFs or annuities, and really it's all mutual funds. Right. So if you need a second opinion, if you'd like someone to take a look at your portfolio and give you some advice on things to maybe tweak or do a little bit different, feel free to give us a call at the office. Myself, Jordan, or Dustin would be happy to sit down and talk with you.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-412-3354.
This week in the office, we had an interesting case that we wanted to share with you guys. We had a couple, John and Sally, who had experienced some pretty large losses back in 2008, and moving into retirement, they just didn't want to go through that again. So Matt, can you help walk us through what we can do to try to achieve that?
Yeah, a lot of times we'll meet with individuals where they've experienced big losses in the past, they're now going to retire, and they just say, well, how do you do this? I can't go through another 30 or 40% drop like we've seen in the past, right. But at the same time, I don't want to invest my money in savings accounts or CDs because right. they're just not paying anything. That won't generate any income. So how is it that we go about it? One of the things that we talk to individuals about all the time is that as you get closer and into retirement, one of the most important things you could do is make sure that you don't take losses, because what's going to happen is a loss is going to hurt you a lot more than a gain helps you as you move closer and into retirement. So, Dustin, if we look at it like this, we get the question all the time where individuals will ask, what is the stock market going to return as far as a percentage over the next 12 months? Yep. And obviously, neither one of us have a crystal ball. But we do know, if we were to take a look at the 100-plus year history of the stock market, if we were to kind of plot on this line each year, we know that the majority of the time the stock market's going to be somewhere between a 25% gain to as much as a 25% loss. Now, obviously, we've seen it like 2008,
Sure.
where sometimes the market loses more, and then occasionally when times are great, sometimes it'll earn more than 25%, but the majority of the time, probably 95%, you can say during the next 12 months, we pretty much know the returns are going to be somewhere between these two numbers. For most, especially as they get closer into retirement, that's too large of a range.
Yeah, you can't do real planning with
You
that.
can't plan on that, right? Because this is going to hurt you really bad, and the chances of that happening aren't very good. So individuals say, well, that's just too wide of a range. Where we want to live with our clients, when we start talking about not losing money being the most important thing that you could do, but you still need to earn a reasonable return, what we want to do with our clients is we want to basically live right here. Somewhere between 0 and 15 is kind of where our threshold is. We want to draw the line in the sand and say, you know what, we're not going to lose any money, but we still need to earn a good, reasonable rate of return, maybe up to, in the really good years, maybe we can earn as much as 15%. But one of the things that's important about this, whereas we talk a lot of times, we're not a perfect fit as a firm to help everybody, what you have to understand is in order to provide this safety, what we're really doing is we're giving up any potential for that. So when the market does great, we're just not going to participate. And when we eliminate the potential for that, what we can pretty much do is eliminate the potential for that, okay? Or even if we had losses, maybe they would be very, very small losses. So the majority of our clients want to basically live somewhere in between these numbers. What that ends up equaling over time is maybe an average return of somewhere between 6 and 8%. So individuals, as they move closer into retirement, they can't ride this big roller coaster. You know, you don't want to have big losses followed by large gains. What you want to do is draw a line in the sand. If you never take on losses, you don't have to take a whole lot of risk shooting for very high returns because you're never digging your way out of a hole. And it sounds pretty simple. Obviously, it gets a little more complex than that, but that's kind of the mindset that individuals have to start focusing on as they move closer and into retirement.
Thanks, man. And that was this week's Scenario of the Week. If you have more questions about how you can accomplish this, please feel free to call our office and/or visit our website.
Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that, it comes down to having a plan.
Yeah, unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much, much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people who have saved for retirement have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon.
So today I want to talk about why the wealthiest in our country are really starting to move a lot of their portfolios into annuities. Not just any annuities, but only the guaranteed products or things that are going to be completely safe from market fluctuation. Now today I want to talk about the top 5 reasons why the 1% are really favoring annuities. Number 1 is risk transfer. It's like if you went to the casino and say you're sitting at a blackjack table and you start building up a big pile of chips in front of you. Well, at some point, you're going to probably want to start putting some of those chips in your pocket and start playing on the casino's money. So you're transferring that risk now over to the casino. You're up. Now it's time to stay up so that you go home a little wealthier than what you did when you went there. So number 1 is risk transfer. The second reason is a pension alternative. Now, 10, 20, 30 years ago, most companies that were out there were offering pensions and income that's going to last a lifetime. Now, retirement used to be thought of kind of like a three-legged stool. You would have Social Security as one of the legs, you would have your pension as another leg, and then you would have your IRA or your 401k or some type of savings plan that you've worked your entire life putting money into that's going to support you through your retirement. Well, now people are living much, much longer than they used to. People are living 20 or 30 or even longer years in retirement. So now with pensions removed from that equation, now it's down to Social Security and your savings. So a lot of times what people are doing, or the 1%ers, or what they're doing is they're using a pension alternative. So they're using annuities as their self-funded pension. That's going to produce a guaranteed income that's going to last throughout the rest of their life. So that would be the second reason. The third would be tax efficiency. So if you have an account where it could be in a mutual fund account or a stock portfolio or even CDs, and you're growing it in a taxable environment, what's happening is your money is being taxed inefficiently. If we think of a year like back in 2008, your portfolio itself could have been down 30 or 40%, and you still get a tax bill at the end of the year. Now, why is that? That's because short-term capital gains that are inside of the mutual fund could have made a little bit of money while overall your portfolio was down. So it's an inefficient way of holding money in an after-tax account outside of annuities. Now, the 1%ers, what they're doing is they're using annuities because it grows tax deferred. So you can put your money in, let it grow tax deferred. So you're not paying any taxes along the way. Each year, you're not going to get a 1099 or any type of statement showing that you owe taxes. Just when you start pulling the money out, you only pay taxes on the growth. So it's a tax-efficient manner of investing. Number 4 is estate planning. So it doesn't matter if you have a will or a trust. With an annuity, it actually bypasses all of that. So it doesn't have to go into court, or it doesn't have to go to probate. If something were to ever happen to you, you can be specific on who you want to receive this money. So with annuities, your estate planning process is a lot more smooth. And number 5 is bond alternative. Now, with bonds, the reason to have bonds in your portfolio is so that you have a little bit of income and then some safety, ideally. Well, with today's interest rate market and the way that bonds and interest rates are tied so closely together, when interest rates go up, bond values go down, and when interest rates go down, bond values go up. Well, where are we right now in the history of our country? We're basically at all-time lows as far as interest rates go. So with bonds and bond funds especially, they're at their high. They're at the top. So now it's time to take some of that money off the table and put it into something that's going to give you a little bit of a guaranteed growth and a reasonable rate of return. So just to recap, the top 5 reasons why the 1% are starting to use annuities a lot more. Number 1 is risk transfer, so taking some of the winnings off the table. Number 2 is pension alternatives. So now you can start funding a pension and have that guaranteed income that's going to last your lifetime. Number 3 is tax efficiency. So you don't pay the taxes every single year. Number 4 is estate planning, so that you can pass things on more seamlessly to your heirs and beneficiaries. And number 5 is bond alternative. So if you have any questions about how you can take advantage of annuities and the 5 things that they do for the rich, feel free to call our office and/or visit our website.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
On this segment of Strategic Wealth University, we're going to be answering some of the questions that our viewers have for us. Now let's get started. The first question is from Amanda C. Her question is, a lot of the people that I speak with about investing only talk about what's happening now in the economy and what's going to happen in the economy. How do you all look at the market, or how do you make investment decisions? Amanda, that is a terrific question. Now, to answer that in a short manner, I would say that we look at what's currently happening, but we also look at what has happened in the past. Now, if an individual studies the history of the stock market, they can begin to see emerging trends or recurring patterns. Those trends and patterns are clues that give us a better idea as to what is happening and what will happen with our present system. There are also major current issues that can go into effect where the market will go. Now, usually these are large-scale concepts and ideas like the Federal Reserve raising interest rates, or an act of terror, or a shortage of natural resources. So ultimately, we look at the present and the future, but we also look at the past. We look at the past to gain better ideas of past trends and use those past trends to determine what the future could potentially look like. Thank you. Here's another question from Jim. Hi, my name's Jim. I'm currently working and I'm wanting to know when I can retire. I have a company 401k, a couple of small IRAs, and I will have a pension. I know that I have funds in different places, so what's your all strategy? What do you do for clients? And Jim, that's a terrific question also. I want to first start with what our goal is for individuals. We give individuals financial peace of mind, and they don't have to worry about losing anything. Now, in terms of investing the funds and where we actually invest them, it really depends on what the goals of the client are. When we meet with someone, we first need to know their financial situation and get to know them better. We want to know their risk tolerance. We want to know how much of their funds they need readily available. And we want to get a better idea of the client's story. The next and most important thing is building the plan or coming up with a strategy. Now, a lot, and of course not all, but a lot of individuals out there giving out financial advice only focus on the investment. They don't think about how this investment is going to affect someone 10 years from now or 20 years from now. And they really don't know what the individual's goals are. Now, everything is centered on the sale, or what is happening now. And an individual who is looking for income from an investment 3 years from now is going to have a much different plan from someone who is planning on retiring 10 to 15 years away from now. Investments and portfolios should reflect this difference. Now, the big thing with us is that everyone is different. And while there are a lot of folks out there who have similar situations, no one person's retirement is identical. We tailor build portfolios and investments to clients' needs. And that's the way financial advising should be. Now, here's another question from Mike. Hi, my name is Mike. I'm 52. I work at a large car manufacturer, and I don't know a whole lot about investing. If you could, what would be the number one thing that I should take away from learning about investing? Now, Mike, that's a good question. I don't know if there's one main thing that you should take away, but if I had to lump together a couple of ideas, I would say first you need to ask yourself, what do I want from my retirement? What are my goals? Having a successful retirement is first getting to know what you want from retirement. Do you want to travel, or would you be happy with just not having to go to work every day? Now, if you can build and develop what you want from retirement, that will help lead you to a path of more successful and a more fulfilling retirement. Now, folks, I really enjoyed these questions, and we'll be sharing more of these often. Now, if you have any questions, please give our office a call or feel free to check us out on the website.